Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. We were speaking to Aditya Khemka yesterday for a brief conversation on pharmaceuticals, but there's just so much that has happened in the recent past that it calls for a slightly longer conversation. The case for a chat today: do FDA inspections and the flurry of FDA inspections pose a risk, or is this routine in the long pharmaceutical cycle? Biosecure Act, and we've spoken about it with Syngene, but what is the investor hat's view on the impact on Indian companies? And of course, multiple other conversations about unbranded generics versus branded drugs and what to do with all of those, what to do with hospitals and diagnostics. And couldn't ask for a better voice, Dr. Amit Varma of Quadria Capital with us on the show. Dr. Varma, thanks so much for joining in. And at the outset, I must say, last evening and this morning, I was trying to research about what have been your recent exits and entries in order to pose better questions. I couldn't figure out too much by surfing the site, so I'll depend on your insights on the same. But I first want to start, Dr. Varma, with something that has been the talking point the last 48 hours, which is a flurry of US FDA activity on multiple sites across the world for Indian pharma companies. Routine or worrisome because so many of them are found wanting of late?
Always a pleasure speaking with you. Thank you for having me on the show.
Thank you, sir.
Our answer is very simple. We have always been in favor of more scrutiny and more inspection because, quite frankly, this is how quality begins to play out. We've just passed the inspection at one of our companies, NQ, and our belief is it makes us better. I think the flurry of activity that you're seeing is that as a lot more of pharma outsourcing is moving into India, you would expect the FDA to be doing its job, which is making sure that they are maintaining certain quality thresholds. So to cut a long story short, we believe that in India, we should be getting used to a higher amount of scrutiny. And that, for us, fortunately, is going to separate the boys from the men.
Got it. It's been there for a while, Dr. Varma. I'm just trying to understand if this flurry, you think that's routine as well? It's welcome, sure. But is it routine matter, or do you think Indian companies are suddenly getting tested or bursting at its seams? I mean, the talk was that one of the companies actually tore apart one of the papers as well. Just trying to understand how you've looked at this recent flurry of activity.
I think we need to get away from this persecution complex and believe that this is the new world and this is here to stay. I also believe that the FDA works on a certain cadence, and it seems like it's coming at the same time, but it also talks about their on-ground presence having gone up, and the fact that as we start to look outside ex-China, India is the next largest market that they have to be looking at. So my sincere request is to view it as the new normal and expect that there will be a lot more inspections by the FDA.
Yeah, okay. So if that is the new normal, sir, are you, based on the cycle that we may be in, are you constructive on some of those pure play Indian pharma companies having US and other geographies as their export hubs, if you will?
Neeraj, the way we've always looked at pharma in India is have a two-pronged strategy. One is make in India for India, and the other is make in India for the world. And we continue to support companies in both streams. So to give you an example, we recently took Akums Pharma to market about 4 to 5 weeks ago. Fortunately, the market has rewarded the company very well. We are up almost 30% or maybe even higher now after listing. And then we've done Concord Biotech the year before, which is basically manufacturing in India for the world. So again, that company is up almost double to where we had started off. So quite clearly, the market is in the mood beyond the clear hype around what's happening in the marketplace to reward quality. And that is what we are seeing within our firms.
Okay. So supporting across that sphere as well. Just that the common feedback that I get when I talk to people about markets at large is that avoid global cyclicals or outward facing companies, including IT right now, and look at the inward facing companies. Does that hold true in the pharma space as well? I know you mentioned that you look at both and you are probably bottom-up constructive on both. But as a top-down approach, could that hold true for pharma as well, or not necessarily, Dr. Varma?
Yes and no, and I'll tell you why I give you a wishy-washy answer, which is not usually my style. The reason I say that is that most pharma contracts are sticky in nature. It's very hard for global MNCs to change their suppliers at a whim and fancy. It requires some amount of a mega event or a major event to make that happen, because as you know, it has to go through a full cycle of compliance and regulation. So I continue to believe that unlike the IT sector where contracts occasionally get written on an annual basis, or there are easier ways of changing vendors, on the supply side in pharma, it is very hard for global manufacturers to change on a whim and fancy. So our belief continues to be, and you've heard me say this before, stay specialized, stay focused, stay niche, and still hold on to longer term contracts. We do not see a change in our strategy.
Okay, okay, fair point. Noted, Dr. Varma. The other aspect is this whole Biosecure Act, and you know, I was talking to Jonathan Hunt and there's Syngene's CFO on what the longer term implications might be. So the longer term implications seem very solid. Somehow didn't quite get a sense after a 20-25 minute conversation as well about whether there is a near term, and by near term I don't mean 1-2 months, I mean in the next 12 to 18 months. I didn't get a definitive sense of whether there is a near term 12-18 month benefit starting as a result of the Biosecure Act in the US for Indian CDMO CRO players. How have you thought about this, if at all, sir?
It's around the hype around China plus one. I mean, there's a lot of commentary around China plus one, and everybody believes the next thing that will happen is suddenly India will be on the map and things will change. I think these kind of big events takes time. And while the Biosecure Act is still running through the final stages through Congress, I think there will be a medium to long-term benefit to India, but you're not going to see a change in the next 12 to 24 months because of the reasons that I elucidated earlier. It will take time, and then we also need to step up to the plate and demonstrate that we can fill in those gaps. But again, when it comes to manufacturing, and that to specialized manufacturing, it's a 24 to 36 month cycle, and you'll start to see changes thereof.
Noted. Okay. Are valuations permissive enough for you to look at Indian CDMO companies for this plus cyclical uptick kind of an aspect? Dr. Varma, do you like Indian CDMO CRO?
So first of all, let me say, and I've said this before, Indian healthcare is insanely valued. So at some point of time, there is a gap between ground reality and what you need to pay for it. We stay committed to the idea of Indian CDMOs because we have a firm belief on the potential of what can be done. I genuinely do believe that Indian CDMOs are also upping the game and upping the scale and specialization, which works really well for the industry. We continue to work with niche players, and we do intend to continue to invest in this sector.
Okay, okay. The one small understanding from you that I would love to have, in a lot of private conversations, some investors tell me that these Indian CDMO or CDMO at large or Indian CDMO as well will have an extended period of consolidation stroke lull, not as stocks but as businesses, and then there is a J-curve effect that could come into place into companies which have got their act right from the onset. You think about this in a similar fashion, or no, not really?
No, clearly, and you've hit it on the nail. I genuinely believe that in the next 3 to 5 years, you're going to see consolidation in all forms and shapes, not just in the pharma side, but in all subsectors of healthcare. And that's because now how big you are and what your capacity is going to define everything that you do. So without a doubt, consolidation is going to take place not just to buff up revenue and volumes, but also to acquire specializations. So you are going to see consolidation to improve the quality of what we are doing, not just the size.
Okay, noted. What other subsectors do you believe will see consolidation? I would reckon hospitals could be it, because you've spoken about that with me in the past and we've seen some signs of that now.
Services. So it's going to be diagnostics and hospitals. You're certainly going to see that. And the consolidation is taking place outside the metros in tier two and tier three cities. Again, COVID taught us in some ways that scale and size, especially from a supply chain perspective, is fundamental. And we will start to see that. I also see this on the domestic pharmaceutical side. There is going to be a host of, I would call, suboptimal size players who are ripe for consolidation and actually can grow if they don't get too caught up in not wanting to consolidate.
Okay, so it's happening at tier 2, tier 3, so cheaper acquisition targets, I reckon, but the average revenue per operating bed may not necessarily be as high as would be in metros and tier 1. Do you reckon that well-priced acquisitions could actually be earnings and valuation accretive for larger hospital chains as they continue to gobble up some of the smaller players?
So I just want to caution that just because it's tier two and tier three, they don't make it very cheap. They're relatively cheap. So I just want to clarify that
Okay,
part.
fine. I stand
And
corrected.
especially if you are in the larger market, state capitals or other larger. Having said that, I genuinely am a firm believer of the volume game, of ramping up volume and revenue, even if my RPOBs are not as great in these centers. But there are ways now of making ourselves more efficient, especially on a cost perspective, which should then flow down to the bottom line, enabling all the numbers that you are talking about, which includes PAT and EPS.
Okay, okay. The interesting twist, Dr. Varma, is I mean, two or three things that happen. One, Dr. Devi Shetty and his firm are doing that insurance addition to their services, and 2 days or 4 days ago, PB Fintech saying that they want to invest in a company which could be the MHO model and HMO model, and then provide healthcare while PB Fintech or some of the other insurance companies could be insurers. And I mean, we were speaking to Yashish Daya yesterday, and he went at lengths to explain how it will be a win-win for both ends. At the same time, I heard other people come in and say it's a model that is not tenable, and they didn't think it will see the end of the day or light of the day. What do you think about this aspect of a bit of a co-joined an entity joined at the hip, and in some fashion each of these tentacles or two of its tentacles providing both healthcare and simultaneously providing insurance?
Dr. Devi Shetty is far smarter and far tenable than I am, so I have to be careful of what I say.
An investor's hat, sir. Let's put it
I
that way.
am not. I am not a. I think it's going to be a very hard challenge to bring insurance and hospitals together for 2, 3 reasons. Number one, the inflection point that we are in insurance, it requires massive and rapid growth, and tying yourself up to a particular chain where your consolidated market share is actually very small becomes harder. I also do believe that between the regulators, they will keep a very close eye on any kind of consolidation that could take place through hospitals. And lastly, at this point of time, the benefit of having an insurance arm attached to a services industry is unproven. And actually, nowhere in the world do you see a situation where the insurance companies control that much of where they can direct their patients. So I think the jury is still out on it. I still have my doubts of whether this can be pulled off, at least in the near or middle term.
Okay. Okay. I remember a conversation that we had maybe a year back, wherein you had mentioned that you subscribe to the theory that branded hospitals and branded diagnostic chains could do very well in India. I reckon you still are of that opinion, and which is why you believe that this consolidation play might actually work as well. So I heard your answer for hospitals. Would you believe the same holds true still for diagnostics as well?
See, my fundamental philosophy has always been that healthcare, in any form or shape, and all forms of healthcare that we do, is about credibility and belief. And since this is life and death, unlike a lot of other industries, your belief is that if you're going to consume something or you're going to get something done or a procedure, you want to go to something which has credibility. Credibility can be built obviously by reputation and by showing your results, but it takes a brand to give you trust. And I think the trust is built over time. So when I talk about branded, it's not about the quality of your advertising and the quality of what you communicate on your pricing strategies. It's building trust over time. And that's where I think if you can make your brand synonymous with trust, that is going to play out.
Okay. Noted. Dr. Varma, one final question really, and that is around this whole belief that tech-enabled disruption for diagnostics come pharmaceutical supply or medicine sales will come out and change the industry. Now, to my novice mind, everybody's still coexisting. Maybe the numbers look slightly different. You might have a better insight. What is your view for the rest of the next 3, 4, 5 years? And when you look out at 2030, do you believe that tech will seriously disrupt diagnostics and medicine supply? Or do you think both models could coexist and that shareholders can make money in both? That was my principal question.
The tech disruption in all the subsectors that you've talked about is inevitable. It is just a matter of time. However, I do not think it's going to play out in the near term that people keep talking about. Again, we are talking about disrupting an industry which has existed for a huge amount of time. And as we've seen around the AI hype in general, of in the first half of the year, anything AI was soaring. And then suddenly you started, people realize, wait a minute, we're throwing billions of dollars into this, but what are we getting out of it? I think you're going to see the same thing when it comes to tech disruption in our industry. There are changes taking place, but they are incremental and gradual. So there's not going to be that one watershed moment that from tomorrow the whole industry changes. So if you ask me with my 5 to 10 year lens, without a doubt, it will be majority tech led and less traditional. But for the first 5 years, it's going to be more traditional and less tech led.
Got it. Great. Well, Dr. Varma, thank you so much. I'm just wondering, before I thank you though, actually, just one last question. Any recent tuck-ins or major acquisitions or exits and the reasons for the same, sir?
Akums was our last one, which I told you we'd taken IPO. And we are in the process of doing another exit in our Indonesian hospital, which we own. Apart from that, on the India side, looking at a lot of subsectors, haven't closed anything in the in the recent past. But as something starts to fructify, I know who to call.
Most certainly. I am interested in knowing this, both off-air and on-air, just to pick your brains and try and understand how you think about it. Thanks so much, Dr. Varma, for speaking to us today.
Always a pleasure. Thank you.
Right. That's Quadria Capital for you. Pharmaceuticals, healthcare, you know what to listen to. Okay, very quick market check, by the way, just before I get in our research powerhouses to try and tell us about all that's moving around. Nifty IT is the buzzword. And it's not just because of Tech Mahindra, because that's not as high a weightage, but 0.8% higher on a day when the Sensex and the Nifty are absolutely flat, deserves a mention. So bear that in mind for sure. But, you know, like I said, that is about the markets per se. But what beyond the market? Let's get you some sector specific and stock specific updates. We have Puneet, Mihika and Rucha joining in with these updates. Puneet, let's start with you first. Auto sales have started trickling in. I saw Bajaj, M&M, I think Escorts, Kubota as well. Take it away. What have you made of those numbers?
Well, definitely. So, you know, M&M is a clear winner. Now, there was expectation of a 5% growth for the passenger vehicle sales specifically, and that's come in at a much higher growth of about 22 to 23%. So it's beaten all analyst expectations. And the theory is that, you know, they've also decided to build up the inventory going into the festive season. Now, they had an inventory level of about 41 to 50 days as per some brokerages of Motilal Oswal as well as Nuvama. This was lower than the other two players, Maruti as well as Tata Motors. So they've decided to, capitalize on the ongoing festive season, and they've already had launches of the Thar Rocks as well as the 3XO earlier this year. So definitely banking on growth and really strong numbers for the passenger vehicle side. M&M Tractors, on the other hand, reported a 2% growth on a year-on-year basis, and that's in line with estimates of 3% growth. But their month-on-month recovery has been over 105%, and that's been, certainly in line with analyst expectations as well. So they are expecting a better second half for tractors, and that's visible in the numbers as well. Its counterpart, Escorts Kubota, has also shown a 120% growth in terms of on a month-on-month basis, and that's been, a strong market for them as well. Now, western part of India has been doing very well for tractors, and that's a market where M&M is much stronger. So that's the reason in the last 6 months M&M has been in the news for the tractor segment as well. But going forward, these numbers are very strong for Escorts. Finally, Bajaj Auto is the other one. Really strong numbers, overall growth of about 19%, and that's led by the domestic market for both two-wheelers as well as exports for commercial vehicle segment. A certain couple of companies to watch out for. TVS will be definitely one of them. Expectations of a 10% growth on a year-on-year basis, but the kind of growth that Bajaj has done, the numbers will definitely be in focus, and as well as Hero MotoCorp. Generally a month before the festive season, they build up inventory substantially. Expectations of about like 590 to 6 lakh units for Hero, and now specifically Tata Motors is the other one, because they were expected to outperform the industry on the passenger vehicle side. Now growth has been very strong for Mahindra, so let's see expectation of 10 to 12% growth for Tata Motors. So these three companies will definitely be in a watch out for numbers that are yet to be reported, but M&M, Bajaj Auto and Escorts really strong numbers who've already reported in this particular time frame. Back to you.
Okay, Puneet, thanks for that. Well, speaking of the Mahindra group, then Tech Mahindra is gaining in trade, and how after CLSA upgraded the stock to an outperform. Still up about 3.5% after being nearly 4% up at a point of time. Rucha joins in with why is it that CLSA is constructive on Tech Mahindra?
Right, so CLSA has upgraded the stock from a hold recommendation to an outperform recommendation, and with a upside of around 10.5% and a target of 1749 rupees. Now, talking about valuations, the brokerage house values Tech Mahindra at 15% discount to TCS. So that is one of the positive points, that the stock is available cheaper than the IT giant TCS. Moving on to the EBIT margins, well, it expects that EBIT margin expansion has already been underway, and now order book is the next sort of milestone. In terms of recovery of the verticals, it expects financial services, healthcare and manufacturing to drive majority of the growth. However, the 15% margin target that the management had mentioned to achieve by FY27 looks kind of unambitious according to the brokerage house. So that is one of a pullback why the brokerage house has not upgraded the stock to a buy recommendation. And also it expects that the initial benefit of the new management will largely start coming up from the next 2 to 3 quarters, as in when the orders start, ramping up. And talking about the stock performance, well, since Mohit Joshi joined as the management in December 2023 last year, the stock is up about 25% till then. So all up to the new management on how it, executes the 3-year target that the company had mentioned in the last call.
Okay, thanks for putting that into perspective. And then move on to the next story. Tata Steel seizes operations of the iron and steel making assets at Port Talbot in UK. Mihika joins in with the details, and the stock really hasn't had any major reaction, so bear that in mind. But Mihika, tell us the significance of this over the longer term for Tata Steel.
Good morning, Neeraj. Not much stock movement because it was expected that, this notification will come through. They've seized the operations of the Blast Furnace 4 at Port Talbot, as well as iron and steel making assets at Port Talbot itself. And these assets are located in UK's largest steel plant. And the operations were seized because the assets had reached the end of their operational life. When you talk about the significance of the Port Talbot assets, the capacity at the port stood at 5 million tons per annum for liquid steel, and they produced different high quality strip steel products. But the steel making will resume at the port around 2027-2028. The company is going to invest 1.25 billion euros to set up an electric arc furnace based steel making, which will also use UK sourced scrap steel. The electric arc furnace will reduce 5 million tons of direct carbon dioxide emissions per annum, and the proposed project will help preserve majority of the Tata Steel UK jobs as well. The company is going to invest in around 750 million euros in low CO2 green steel making via the 500 million euro grant that it received by the UK government recently. A little bit about how the plant was actually harming financials. Well, FY24 annual revenues of the Tata Steel UK, which includes Port Talbot, was around 2,706 million euros. But FY24 EBITDA loss was at 364 million euros because of the end of life conditions of the assets.
All right, Mika, thanks so much for putting that into perspective. That's all the time that we have on this edition of Talking Point. Thanks so much for tuning in.